Nothing that we say is investment advice. Please pause on all 3 pages of this disclaimer and read it.
Good morning, everybody. It is Cowboy. It is Sunday, not a typical time to come on live. It is, let me see here, June 29th. I don't even know what the date is. I love how Sundays are. And it is 11:37 on Sunday. And so we had a couple of last minute format changes that got us on a little bit later than we planned, but we've got Larry here, and Larry is a newer client, and he's going to remain incognito. But he wants me to help him, as I do with clients, work on his algo. So any of our clients who come into Algo Factory to build their algo, which you can see on the screen right here, at least in part, those clients have 2 built-in or paid for, if you will, coaching sessions, right? It's an hour of coaching. And then after that, I charge for that, but you have infinite amount of basically free coaching sessions if they come on and do videos like this. So that's what we're doing today. Larry, how you doing, bud?
I'm doing amazing. Thank you for the time.
Yeah, no problem. No problem. Now, Larry, you came in and you jumped in and you're like doing the work. So there's a lot of members who, look, I get it. Everybody's busy, right? And that's to be expected. Just people are busy. It is what it is. But I don't know anybody that cannot carve out 3 hours a week, right? So 3 hours a week to build your algorithm, right? At first, you're going to watch some videos. You're going to learn how to do it. You know, you're going to join our Telegram, talk to people, talk to myself, just to get the basics down. And then you're going to get started. And the videos, the courses, the modules at the university give you everything you need in order to do this. And I'm always kind of improving that as well. But Larry here, it seems like you've built something that might just be profitable from the get. So why don't we go ahead and jump right in? I'm going to start talking about what we see on the screen, because this is Larry's algo here. And there's a lot of noise in the screen. One thing I'm going to do here is point out this kind of blue and purple, and that is it's an ATR stop loss. And I'm going to hide it because we only need it at certain times. So we're going to make the screen like less noisy. Right now, what we do at Algo Factory is we stack indicators and we use multiple time frame analysis. So what that means is that we take a look at what's going on for the greater trend, right? So high time frame means you're looking at what's been going on the last couple of months, so that you can figure out, hey, is the market generally going up or is it generally going down? And if you can tell that the greater trend is bullish and everything's going up, then at least the way I trade as a trend trader, is I'm going to take longs. You're just going to have a better chance of winning your trades by doing that. Okay. So that's what we do here. Now, Larry actually started off just on one single screen with one time frame, not even doing the multiple time frame analysis. And you can see the data on the bottom of the screen. And that data on the bottom of the screen are the indicators that he is stacking in order to make this happen. So let me do this. Actually, I'm going to not do that. Let's see here. I want that space on the right. So, Larry, let's go ahead and talk about the indicators that you're using. You got a volume oscillator on the bottom here, this blue one. I'm going to adapt it so that people can actually see it a little more easily. And then you have the Williams %R, which I've actually used before. And then you have a stochastic RSI with some special settings that we only talk about at Algo Factory, some secret sauce there. All right. And go ahead and just, tell me how your algo works. Just go ahead and say, hey, this is what I do and this is how it's done.
Well, what I was trying to do is use the information from the modules on diversifying what indicators I used. And then went in to try to understand each one and what the indicators mean, test them by tracing it out, and then stack them on top of each other to give me the best indication of where the market's going outside of looking at structure.
The Algo Factory way.
And then just testing it that way. Now where I'm at is fine-tuning it down to the point where I wasn't looking at anything else other than the indicators and not looking at structure markets and putting in the boxes that you teach on like resistance levels and tracing out your fib levels and everything like that. I just ran it off what the indicator said at a strict risk to reward number. And that's where I set my stop losses. Then went in and set the ATR for the stop loss and did a back test on it just to see if I understood what it was doing in a back test environment, which it's been positive, but now it's getting to the next level of understanding the fine-tuned details. So I've been drinking a fire hose, and now I'm kind of limited, trying to slow that down.
Yeah, well, I think the audience is drinking from a fire hose as well. So let's back up a little bit, and let's actually let's do this really quick. I just had to change one thing there. What I want to do is kind of eat the elephant in small bites here. So
Okay.
because a lot of that talk was, I know you get it, but I think a lot of people may not. So now, in order to get this video, you're going to have at least some understanding, or you could do like I did when I started trading and like eat the elephant. Learn by osmosis. So I would just I would get into what was going on, and I would I might not understand all these terms, but I would just kind of move on without understanding them. Like, okay, they keep using this, this term here, so I'll look that up later. Or, we have the power of the internet at our bare fingers. We could just, tip of our fingers. We could just literally look up whatever trade. Oh, he said risk to reward. What does that mean? So first of all, let's start with the algo mechanism. How are you using these indicators at the bottom to determine when you enter a trade?
So I have to have all three match up. My stochastic has to be above the 80% mark.
Okay.
And then the RW percentage has to be above
overbought, basically.
Yeah, it's got to be above the 20. It's got to be less than negative 20%.
Okay.
Or at zero, where I had it set at.
Oh, that's okay. So let's start one at a time. So your first indicator here, stochastic, you need it to be above 80 to go long.
Correct.
Okay, so you're not going long until up here.
Correct.
Because most people are not doing that. Most people are what they're doing is they're waiting for it to go above 50, not 80. So we'll talk about that. Because 80 is overbought on a stochastic RSI, so the price is going to want to slow down. But I'm going to tell you this: if you're winning your trades, who cares? Because we'll get deeper into that in a minute.
Where I was looking at the adjustment is just being a little bit overzealous on what the trend is on there, and seeing if it would work at above 80.
Gotcha. So now this is your Williams, your percent Williams, right?
Correct.
And with the percent Williams, you're letting it go above negative 20 up here.
Correct.
So when this breaks above here, you're getting into the trade. And then this is your what's this bottom one? The volume oscillator.
Volume oscillator has to be greater than 0%.
It's greater than 0. Okay.
Yes.
All right. And then when those things line up, you take your trade, right?
Correct.
Okay. I think I already have something that can supercharge this for you, but we're gonna hold off on talking about that. I think I have something that will actually make this go even better for you. But let's go back to when you first started testing. So you said it was 2023. Like, what's the date?
January 1st.
Okay, so for those of you who might be new, you can't see the bottom of the screen. Let me get rid of this on the bottom. By the way, on the bottom, get your free algo right there. You can see it. Links in the description. Go in there, click on the link, give us a real name, fake name. We don't care. We'll send you a free algo, and we'll also send you updates on the market and stuff like that in your email. So now that I've gotten rid of that, you can see at the bottom of the screen here, this little arrow or this little calendar guy. So you click on that and you go to 2023, January 1st. 0101. Okay. Hit go to, and it takes you all the way back there. And that way you don't have to, scroll. All right. So first of this. Okay. So here he is. All right. Now it looks like you're doing pretty well. You said you had a bunch of wins, right? Looks like you got one loss right there. These are all your, for the audience, these are all of Larry's old tests. So it looks like this larger trade did end up stopping out. But in this case, you have a trade that appears to either stop out, almost stop out, or win. That's going to be a real close call on that one.
It got stopped out on that
Is it?
last one.
So all three of these got stopped out.
Correct.
Okay. That's fine. You're going to have that in real trading. Like a perfectly good, very successful algo will stop out, and it will sometimes stop out a number of times in a row. When we trade, what we do is we build a system like we've been talking about, using this gobbledygook at the bottom of the screen. And it might seem complex to somebody who's watching, but it's not. It's not that complex. We teach you how to do all this stuff. All you got to do is to be able to read a chart, and we even teach you some of that. So don't worry about it. If this is boggling your mind and crossing your eyes, don't worry about it. Just watch, take in what you can. You build, you learn as you go. You have 2 wins right here. Okay. How many tests did you do?
40.
40. All right. So you won that one. You lost this one. Now, the thing about this one is, and we're going to talk a little bit right now about risk to reward. So you see these boxes right there? What Larry's doing is he has set his risk to reward at 2 to 1. And what that means is that his wins are twice as big as his losses, right? So if let's just say price is going through here in this box, because this is the box we use to do risk and reward. Well, let's just say that, you start right here, price goes up, goes down a little bit, goes up, eventually makes its way up to up here. Well, now if the trade goes out of the bottom down here, Larry has lost, for his testing purposes, $10, because you're risking $10 on every trade, right?
Correct.
Now, if your trade goes out of the top right here, then you're making $20 because you're going twice as far as you would on the way down, right? That's why you have a risk to reward ratio of 2 to 1, which might be hard to see on the screen, but you can see it there. And this little tool really helps you out. It's over here on the far left of TradingView, right? So that's how Larry is doing. That way, Larry, let's just say you lost 3 in a row, you lost $30, and then you win 2, you just won $40. So winning 2 not only covers those 3 losses, but then and then some, right? That's why we have a 2 to 1. And you might even test to do better than 2 to 1. This is just an initial test where you're seeing what works. You get a loss here, you get a win there. So you got a loss there, you got a win here, which, in a perfect world would be a massive win. Now, if you were doing high time frame, multi-time frame analysis, you could stretch this out and get yourself like a 5 to 1.
Mm-hmm.
Right. And we're going to talk about how we might be able to get that for you. Okay. Now you're doing the euro, EUR versus USD. This is a forex chart. We trade. I trade personally primarily forex, and then I like to take the wins from forex and put them into things like crypto or gold, real estate, you name it. Right. Because if you do that, look, crypto is tradable on a higher time frame. Don't get me wrong. I have traded crypto more than anything I've ever traded. I traded Bitcoin primarily for many years. So I know how to trade crypto probably better than almost anyone you know. However, I find that trading Forex is more predictable with more opportunities and less noise in a lower time frame. So I can sit there and trade, I can day trade Forex. Day trading crypto is really risky and high fees, not so much a Forex. So you cataloged your data, right? Do you have a spreadsheet that you have ready to go?
Yeah, I can.
If you can you throw that in the Telegram?
Yeah.
You just use the paperclip and just throw it up in there. So this is, so far it's going really well. And while we're getting that spreadsheet ready, what I'm going to suggest here, I'm looking at your tests, and you're waiting for the stochastic to go into the above 80. But look, the way the stochastic works, and the way it's, at least my understanding of the stochastic RSI and the way it's supposed to be used, I'll hold out. Larry, did you, I'll wait until you actually do that, because I want you to see this. So, because you go ahead and do that. So the thing about these indicators is that you have a lot of traders, especially in crypto, who kind of have been doing things their own way, or they've been doing things the way that they see other guys do. One of the things I've noticed, especially with crypto, is people using the VPVR, they use it the wrong way, right? Now, if you use it the wrong way and you back test it and it ends up working for you, then by all means, but it's not how the indicator was intended, right? So a lot of like the VPVR, I'll show you just real quick while Larry's getting his data. I didn't tell Larry he needed to send that to me, so that's on me.
You want it in Telegram?
Yeah, I just sent it in Telegram.
Okay.
So I'm going to put on the VPVR to show you what it is and how people use it the wrong way. Find profile, visible range. I see it there, Larry. Thanks. So let's see if I can get volume profile. Visible range. Okay. So that didn't work out too well, did it? Let's see here. VPVR. That's weird. All right, well, I'll just have to delete that. I'll have to use a different one. VPVR. Aggregate VPVR. Okay. VPOG for all accounts. We just tried that one. Let's try this one. No such luck. Maybe it's because I'm on forex. Oh, you know why? It's because you're on Kraken. All right, we'll skip all that then for now. Sorry, folks. We're not on the right exchange to use VPVR. So I'm going to bring up a file here. And we're going to flip over to that screen in just a moment as soon as I can do that. Let me see here. Okay, shoot. That's not going to work out. You know what I'll do is I will present, share screen, window. What is this? The 4-hour euro? Interesting. Share. Okay, let's do this. Okay, so, where did that go? Oh, screwing things up. Hold on, folks. Screwing things up. Let me find this. See if I can. There we go. All right. So I'm going to expand this and I'm going to zoom in. And this is perfect. I like how simple this is. When I have a lot of people backtest, what they do is they go overboard, right? But you got just a few simple columns here. You got date, time, position, profit, and loss. So you have the date of the trade, the time, position, P&L. So you did a summation function on here?
Yeah.
Nice. You know how to use Excel. So you had $160 in profit over 40 trades over 8 months. So
correct.
Now $160 profit on $10 a trade. That's a $1,000 account?
Yes, that's what I based it off of.
And that's at 1%.
Correct.
So $1,000 account at 1% is up 16% in 8 months on a back test. Now, we always want to be careful with back testing because we do a little something called overfitting. Now, I can tell, Larry, that you've done it properly where you're getting in the proper candle and you're not. I mean, but the back tests are always going to have numbers that are just a little bit better than reality. It's just how it is. But yours, I can tell, was conservative because you entered on the proper candle, which is where most people screw up. Now, most people do a 2% money management. So what that means is on a $1,000 account, people are going to put in $20 a trade. Now, Larry, you did 1% just to probably keep it simple. But in reality, it would be up $320 because 2% is pretty conservative and pretty normal. So you would be up 32% in an 8-month span. Now, the way that we've designed this algo, we being Larry, but also kind of, listening to some of the recommendations that we do here is, let's do this again here. What we do with trading is that we got to tailor it to your life. And Larry, you work more than a 9 to 5. You work a lot. I think you worked more in the past 4 days than most people have in the last 2 weeks.
Yeah, it's been a rough couple days.
which is awesome because that just gives you a bunch of seed money for your trading. So what we did was, and most of my clients have that scenario, they have a job, they got to make money. So I say, hey, swing trade. Swing trade means that you're choosing trades that take days to occur. So you can actually see that a trade is coming like a day or two before it happens. And so as your conditions are met, it's really easy just to enter the trade because these trades take between a half a day to a day or two to complete. So this is something that you can do if you're driving a truck or if you're, working at a restaurant or whatever it might be. I started trading while I was working 12 hours a day and I was running union crews in construction, and you can't break. And I wasn't in the union. I was just running the crew. So long story short, I can't stop what I'm doing, while those guys are doing their thing out there. I had to trade when I could trade, which is basically non-working hours or during my break. So this is a perfect thing to do. And with that schedule over an 8-month period with 2% money management, you have an account that's up 32%. Do you know anywhere else and this is just, back testing, and there's no guarantees in trading. And, there's just aren't any guarantees. You could have the perfect algo and lose 10 trades in a row just because the market doesn't go your way, but that's extremely unlikely. And trading is all based on probabilities, right? In fact, your probability of win, your win to loss ratio, let's just get a quick expectancy number for you really quick. I'm going to go back to your screen. I'm going to open that up. How did I do that before? Give me a second. Open with Excel. Good. And then let me reshare that screen. We're going to do a little math to show you just kind of what's going on with that. Okay. So let's do this, and we'll zoom in to 200%. Good enough. We shall maximize. Well, Excel's being a pain, so we'll just do it like this. Come on, Excel. That's what happens when you try to use a Microsoft program on Windows. It gets finicky. All right, so P&L. So if I were to do wins versus losses, I could sort. Where's my sort? A to Z, largest to smallest, sort. And I have all the wins here. And so you have 4 to 21. So you have 17 wins. And you have 40 minus 17 losses, right? So you got 23 losses and 17 wins. Okay. And I'm going to go with the number 230 just because that's kind of more of the what is it? What was your sum was 160, so 320.
Yeah.
Okay, so 17 wins. And this isn't editing your screen, by the way, Larry. I have my own, sandbox here.
Okay.
17 wins, 23 losses. So you have 40 divided by 17 divided by 40. Do a quick bit of math here. That's a calculator. You have a 42% win rate, which is great because you have your risk to reward ratio. And you have an RRR of 2 to 1. So when you win, you're winning twice as much as you lose. So your expectancy, let's figure that out. So expectancy is, and we're going to merge these cells here. Format cells. Man, it's been a minute since I've used Excel. I'm trying to remember how to merge cells.
Top, middle, above the E. Merge and center.
Where is that? I don't know.
In the tab at the top, above the E, you can do merge and center.
Above the sum?
No, to the left, above the E tab, you see the merge and center in the center in the top of the screen. Yeah. Right there.
Oh, the E column.
Yeah, the E column.
Gotcha. Okay, so expectancy is win rate times RRR minus loss rate times 100. Right? So, and that's got to be a negative. No, it's not. Okay, so the minus makes it a negative. Okay, so win rate times risk to reward ratio is going to be, where's my merge? Where's my merge? There we go. Win rate, we came out with basically 42%. So 0.42, right? 42% expressed as a decimal times 2, which is 200, right? Because you always win 200 when you win. Minus, oops, let's see here. And your loss rate is going to be 58%, right? 100 minus 42%. 0.52 times 100. So we're going to find out every time you click the button how much money you win on average. Whether, you know, factoring in your wins, factoring in your losses, right? And we're going to do this based on, let me see here, times 200 times 100. It's going to be times 40. Sorry, guys. 40 and 20. So when you win 40. When you lose 20, right? We're doing 2%.
Correct.
Sorry about the confusion. So loss rate's always, I'm doing a $100 deal. Okay, so you got 42 times 40, 52 times 20. So 0.4 times 40. There's my other phone. Let's see here. 0.42 times 40 is going to come out to 16.8. And you're going to subtract that. I see 0.5 times 20. 0.52 times 20 is going to be just over 10. It'd be 0.11, I think. 10.4. 16.8 minus 10.4. You're going to end up on these, let me see, that's going to be roughly like, you know, well, that's going to be exactly $6.2. Okay. When you do that enough times, you're going to make your money, right? And this is on, you know, basically risking $20. So 0.4, that doesn't sound right. 0.42 times 40. That's why. That's the problem. Oh, no, that's right. Okay. So on a very small account, you're making $6 every time you trade. It's factoring the losses, factoring in the wins, right? That's the way that expectancy works. And on a larger account, this number is going to be like $60 or, you know, a few $100, whatever it is. So it's, if you're following your plan, every single time you click a button, you're making that much money. Now you might lose that time, you'll win the next few times, whatever it is, but the average is that amount. And then as you live test, you're going to, you know, get a little bit different of a number, but it is going to be, you know, it's going to be like usable, right? It might be, instead of 6.2, might be 5.8, because back testing almost always yields a little bit better of a result. So let's stop the screen here. Let's get into the actual algo. Now we've talked about the way it works, right? So just a brief review on that. When the stochastic goes above 80, which 80 is right here. This is for longs only. This works for shorts too, I'm sure. But you're not going to enter the trade until this blue goes above here. That's one condition. The second condition is the same kind of thing. You're not going to enter the trade until this purple goes above this line. And then your third condition is going to be the same thing, right? Everything has to go above that line for your conditions, right? In this case, it's 0%. Now, I wouldn't mess with the volume one. And I don't know enough. I've used the Williams percentage one before. I have. But I've used extensively the stochastic RSI. And the way this is actually created and meant to be used is that when the stochastic RSI goes above this 50 line right here, let's use this guy right here. When it goes above that line, that means price is bullish. And when it goes below the line, that means price is bearish. So if you were to change your algo, just simply, I think, to where not waiting for it to go into overbought, because when it goes into overbought with stochastic, that means that it still could be extremely bullish. A lot of people use this wrong. A lot of people actually will want to sell when price gets up here. And while that can work, if you simply do that all of the time, there's a good chance you're going to lose money. So that's not how it's meant, right? It's not how this is meant to be used. The way the stochastic is meant to be used and traded is that when price is above 50, it's bullish. It's very, very simple. Now, when it gets above overbought, yes, it's overbought. Yes, it's going to slow down. But guess what? Look here. In this area, it stayed overbought for like a whole day. And price probably continued to go up during that time. Let's test that out. See here? So let me stretch this out a little bit. During these two lines, when price went overbought on the stochastic, it just kept going up. So if you shorted into that, then you got murdered. That's not that. This is why we don't do that. But a lot of people, they treat it that way. They don't know what they're doing. But in this case, I would have started looking for a trade right about here when price went above, or when the stochastic went above the 50. That's about the time things get bullish, and you can see it on the chart. Now, I don't think that's going to line up with the rest of your indicators, but it might. Let's see what happens. Oops, wrong button. So let's do this. So no, it didn't line up with these. So you didn't quite get there, but it eventually did. It lined up right here. You probably just didn't take trades back this far, maybe, but your conditions for your trade were met right here. And this would have been a winning trade for you. And without even using my conditions, they're just changing that one condition. But I bet you there's times where, here's an example here that would have failed you. I'm trying to look for a good example here. It kind of looks like these indicators are more or less in sync. Might have a hard time finding a good example. Here's one. So here's a trade that had you with the stochastic being above 50 right here. Your other indicators would have gone into play right about here, which would have put you in where your trade is, where you normally trade. So you're doing long trades. So is there a reason why you didn't take this trade right here?
Which one was that?
Well, I'm putting it in right now.
Oh, because I was already in a trade.
Okay, so you're not, well, you were already in a trade here, and you took these two now?
Yeah, I started looking at that.
Okay.
I was kind of playing around with it.
So you're talking about pyramiding. So you can only test that, right? You have to test pyramiding to see whether or not that works out for you. Okay. If you're already in a trade, whether or not the other trades play out, you could do that. But most people don't pyramid more than once or twice, because then your exposure is going to be too much, right? You're going to expose yourself to the same asset pair too many times. And if it goes your way, then you're taking all the hit. So, a lot of Forex traders, they won't take more than one trade or two in the same asset pair. They'll want to diversify into other asset pairs, but that's, hey man, if you test it and it works, then you test it and it works, right? That's how I see it.
Some of those I was putting in just to understand it as well, to see how it would play out.
Gotcha.
Because I was replaying it and then seeing how it would have done. The yellow lines are the trades that I actually documented.
Gotcha. Well, here is a trade that the stochastic is above the 50 and your other indicators are in place. And let's talk about your stop losses real quick, because people are probably wondering how we're doing that. We're using an ATR stop loss. So I just put it on the screen. Now, I don't have that on the screen until I need it. And let's see if I'm doing this right. Okay, yeah. So the candle is this candle. So if I were to enter this trade, put in my long box at the end of that candle, then my stop loss would be where this purple line is on the bottom, because that's an ATR based stop loss. And the way that, Larry, you have your own formula as to how deep that stop is. Now this trade would have failed though. you just stopped out on a 2-to-1. It didn't quite make it, did it? So it might be that the way you have it is just the way to have it. Let's see here. It does seem like these indicators are fairly in sync that way. It seems like once one goes, they all go. But you could, let me see. Yeah, it does seem that way. Yeah. Doesn't seem like what I was talking about is necessarily going to work out for you just because of the way you've got this set up. It's interesting. I've never seen a stochastic scenario where people are literally entering on the overbought for longs, but it's working for you. So what you've done is you figured out how to do a breakout trade. That's what you figured out. And you may be one of the few who's doing it without a multi-time frame.
Okay.
But let's go ahead and do this. Let me get rid of my mark here. Now, what we could do is supercharge this because you have these big moves up, but you're only taking out this little bit, right?
Correct.
So I like multi-time frame analysis. So what we'll do is we'll go ahead and open it up.
Well, one of the other things I was going to look at too is, like you said, I'm waiting until it hits 80. And I know traditionally it's above the 50 on the RSI. If I drop that back, am I able to capture it sooner and still have more of a keep the same win ratio?
What I'm seeing right now, at least for the way I was looking at it, doesn't seem to make a difference.
Okay.
Just waiting, getting that stochastic above 50. And then, I mean, it worked on this one that we looked at that was in the trend. So it might be that we have to look at it that way. It's got to be the trend. Now, what I do with multi-time frame analysis is the left screen is going to be my trading time frame and the right screen is going to be my trend because we read left to right. So that's just how I've got to do it, but you can do it whatever way you want to do it. Okay, so this is on the weekly, that's on the daily. That's weird. Okay, going back to 2021. Okay. So here, oh, you know what? We haven't linked up your charts properly. So let's do, you want to have the symbol, the crosshair, and the time. You want the time to be linked up on these. That way, when I click on here, it brings the weekly to where it is, right? So if I click on the weekly, watch what happens. Right now, my cursor on the right of the weekly is in 17 July 2023. On the left, it's in like December 2023. But when I click on the right, it brings it to, it syncs these two up. And the way you do that is by having time selected down here.
Okay.
So your trading screen is on the left, and you've built an algo that really may not need multi-time frame analysis, right? Because you're winning, at least so far, with just a single screen, which is kind of the holy grail. People don't want to have to do multi-time frame. But what you might be able to do is to extend your wins with multi-time frame and have separate P&Ls for that. And I would only use like maybe your stochastic, and not these other indicators.
Okay.
That way you're going to keep it simple, right? So if you're only doing longs, then what we could do is have some higher like TPs, higher take profits when your stochastic is above 30. So if I were to do this, I would do it as such. What am I doing here? Okay, so I'm going to kind of do a background code here. Let's do it like this, date range. So it goes above 50 here, and it kind of goes below 50 right there, right? And in fact, I might not even wait for it to go below 50. What I probably would do, so for the bullish period, it goes above 50 and you're good to go, right? Let's just focus on that for a minute. Let me open this screen up and let me open up this indicator. So the way we're going to like test this out right now, to keep it extremely simple, is that the time to take long, or the time to do extra take profit on longs, will be once the first candle closes with the blue of the stochastic above 50. That's when we start. And then we stop taking longs as soon as the blue crosses below the orange here. So right there. Because as it's heading down, you're not going to want those trades. So that's generally how it works, not always how it works. But on a higher time frame, that's how we're going to go. So, and in between these lines, that's where we're going to expand our profit taking to maybe like 3 to 1, or we could do 4 to 1. Like, you got to test it, right? So I'm going to code this green because, bullish. Not the text. I need this to be green. So when you have like a green background, that's going to be time to, risk a little bit more. So if we go back to our screen here, this green background pasted over from the other, right?
Mhm.
This one would not have gone any better. This one would not have gone any better. This one would not have gone any better. Nor to this one. This one would have. But these are all losses here.
Yes.
You're on the far. You need to be in the daily, not the weekly. Okay, so that's their first problem. If you're going to be a swing trader on the 4 hour, then you're. I don't know if I maybe said this wrong when I talked to you yesterday, but you want this to be on the daily.
Okay.
So that might. But again, we talked yesterday. I think I said the weekly. I might have meant the daily. So, and now you can parse it out to the weekly. You can supercharge it. But in this case, yeah, the problem here is that on a higher time frame, you're getting nerfed right here. The other problem is that you just traded after a news event right here on March 23rd. But you're still profitable regardless. Interesting. All right, so how would this work? We might just have to find a better filter for you. Let's add in MACD. Okay. Yeah, we might have to find you a better filter. That's just the case here. 4,624. Yeah, that's right. That's the. So here. Okay. All right. So let's make our filter on the daily an MACD that is above 0.
Okay.
And is green, basically, right? Like, so the blue is above the orange, which is going to make the histogram green, and it's above 0. So in this case, we're going to make our sort of timeline here, our period of green, if you will, through here for now, just for our test. All right, so we can take more profit in this time. Now, what's kind of tricky about this is that, like, this trade that won for you probably would have lost because you had this nasty wick down afterwards. You see that?
Yeah.
So that's just bad luck. This one would have lost. This one, let's just say it went 3 to 1. That would have won, right?
Okay.
And this one, you went 3 to 1. Would have won. You could have gone probably 4 to 1 on both of those. So just in that, it's just a way to kind of tweak a little bit. It's going to add some work to your back test. But it's really simple. If you're in that green period, you just go 3 to 1, or even maybe 4 to 1. See if 4. Wow, that's again, this one would have lost on a 3 to 1 because it didn't take profit, and then you had that nasty wick down, so that'd be a loss. And this would be a loss anyway. So this is minus for you. I'll go with your $10 one. So that's minus $20. But then you get plus 30 and plus 30. So you got minus 20 plus 60, right?
Mm-hmm.
Where you would have had plus 20 minus 10 plus 20 plus 20. You would have had this like plus 60 minus 10. Yeah, minus 50. I think that's the same either way for you in this case. But if I forget already what it would have been with the new metrics here.
New metrics was going to be a net positive of 40.
And this was a net positive of 50. But
Correct.
over time, and that's because you had that shitty wick right here.
Yeah.
That's just kind of a bad luck deal. Now that's because you're not using structure. You're just using ATR stops.
Correct.
So what I would continue to use ATR because structure just involves a lot more work right now. Like I use structure in my back tests a lot of the time, and it takes more time. But that's what I do. So, and I tend to get better results than strictly ATR stops.
Okay.
But it's just a lot more work, and I would have you get through your first back test, and whether or not, like, what I would do with this, if you want to back test with the higher time frame deal, you just have to look at the higher time frame, in this case the daily MACD, and you just have to make sure that your trades are within, right? Like this actual trade right here is within that, because you're back into, well, it wouldn't be actually, well, this is real kind of tricky, because on this trade, this is on the daily, this candle hadn't closed yet. So you probably would not, well, you didn't enter until the next candle though. So it might be that you had the higher risk to reward, but you lost that trade on doing it your way you won, doing it my way you lost.
Correct. Yeah.
And then you wouldn't be, you would just be taking regular risk to rewards. You could always do this as a filter. Let me take a look at these next few trades. Instead of like a add risk to reward, if that's not working for you, you'll notice that this might be just the way to do this. Rather than try to expand your risk to reward, that may or may not work for you. You got to test that. But you could use this as a filter to avoid bad trades, or to only go short. Because if you look here, you're only going long in this testing, right?
Correct.
So if we were to expand from here, rather than try to augment your risk to reward ratio, we could just make this as you can't trade during this time, when the high time frame is against you. So we'll code this red. And we're looking at a very small sample. So the problem with small samples is that you're not really seeing over time, right? That's the thing. So the way the test turned out here, let me make this less severe. Let's do like that. The way it tests here doesn't mean it's just necessarily going to test, that way over time. But in this case, let's go ahead, expand this, and we'll see these trades. Did you lose them? You lost that trade, you lost this trade, you lost that trade. You won this one, but you lost that one. And you lost this one. So you have 5 losses and 1 win in this period. You see that?
Yeah.
So when the high time frame going your way may or may not help you to expand your risk to reward, right?
Yeah.
So maybe we don't do that this time. Or maybe you do a test of like maybe 40 or 50 of them, and you see how that works, right? If you're doing a test of like 50 of these or 40, and you're seeing a significant increase in your P&L, then it's worth a shot. And you can always filter that out of your tests, right?
Okay.
Or the other way about it is, on your spreadsheet, you just add an extra column for high time frame augmentation, right? So you take your you can test it both ways, right? This is where you start to go down a slippery slope, because you're going to all of a sudden want to do like 10 different modifiers on your back test. And pretty soon each test is taking, 30 minutes and you'll never get done. But what you can do is simple modifiers like this. If you see the filter, don't take the trade. But guess what? This is when you're taking shorts anyway.
Mhm.
So really, the way I would do this, if I'm not, maybe ignore the like augmentation for now. You don't want to do too many things. But what I would do is this is when you take longs, and this is when you take shorts.
Okay.
If the MACD is green, you're going with longs. If the MACD is red, you're going with shorts. Now, on your current back test, only doing longs, that means you're out of the market half the time, right?
Yeah.
But in this case, let's look at this next kind of period. See, you lost this one. You happen to win that one because it just started going your way after you entered. Because indicators lag. In fact, I give special. Let me do something real quick. Whose is this? Okay, and let's do this. Inputs 821.8. Okay, let's just modify this a little bit. Let's do 8. We're gonna make the MACD a little bit faster. I'm gonna change the settings. Okay. So in this case, you still would have missed this trade. But I made the MACD a little bit faster. So like here, during this whole period of time, from here to there, you have a lot of short opportunities that you're just not getting in, right?
Okay.
So let's see what happens if we do on our trading time frame. Let's do a couple of tests. Make sure nothing important is going on here. Good, everything's fine. Okay. Just getting a bunch of messages all at once. Let's go back to the beginning of let me lock this so we don't mess with it. Lock. Okay. So our conditions on this algo, of course, are going to be when all three go below. In this case, you've got it right here at that little green nubby right there. We'll make this red, beginning of your short. Okay. Now what happens if you go short here? Well, we've got our green this is our ATR stops for shorts. And we have that at, Larry, I'm not going to give away your number on that, but we have that at a certain number. So let me zoom in here. And we'll put our ATR stop here. And then we're going to go we'll just go 2-to-1. We can always test this later at 3-to-1. Or you could always parallel test it too at 3-to-1. That's the easy thing to do. And this is a winner at 2-to-1. And it's a winner at 3-to-1, I can guarantee you. Now, this loss you wouldn't take. Oh, no, you won this one, I think. Did you win this? Yeah, you would have won this one, but you wouldn't normally take this in this case, right? But you would
Not
have.
if I was using the filter.
Yeah, not if you're using the filter. Or, yeah, he's right. You only going long or you only going short. So in this case, nothing works until here. And it's actually here. And you would lose this trade. You're starting to bottom out. And that's fine. There's other things we could do to mitigate that, but let's just take our losses. It's not a big deal. So not every trade's going to win. So you'll lose this trade for sure. One thing about trading, guys, market doesn't always go your way. All right, so your next trade's down here. So you got here, here, and here, and not until here. And you're at a 2-to-1, that's a win. And you're almost at a 3-to-1, but you don't quite make it. So your 2-to-1 is probably the way to go right now. You can always optimize, You can always optimize. You almost come close to stopping out right on that first candle, but you don't. Optimizing is like, okay, should my stop loss be at, or do you win this one? That's not true. You lose this one. As much as I want you to win, you don't. Yeah, you lose this one. See how it pops up there. So that's a loss. Market just doesn't go your way. And you know what? This is in the morning. This is a news event right here.
Okay.
So I wouldn't be entering. I generally don't enter trades before a news event. I wait till those happen. So this might have been a trade to avoid. I don't know. I'd have to look at the calendar, right? So I'm only guessing that's a news event because it's at. If I go down to a 30-minute, I can almost guarantee you this could be a news event. Let's see. Let's do this and this one right here. It just doesn't go back that far. All right, that's fine. I could get it to go back farther, but I'm not gonna. All right, so well, let me see if I can just. How far back is this? Yeah, that's not gonna happen. All right. Anyway, back to the. I was gonna try to. I have some ways of kind of gaming this system to get what I want, but we're not gonna do that. So let's go back into because a 3 or 4 hour is what it is, and we're on the daily good or where we should be. Okay, so we lost this trade. It's fine. And then our next trade will be. Did we lose our? We lost some stuff here.
I think he lost the filter box.
Yeah, lost the filter. It's rather annoying. I don't know how that happened. Oh, we lost the filter. Just put it back on, I guess. That's weird. I don't remember deleting it. Okay, there it is. There's our filter. Okay, nasty open there. Yeah, you wouldn't have, that trade didn't work out for you. Wouldn't have been able to enter that, which is good. It's a shitty trade. This one is a proper trade, and I think you would have lost this one. So nasty choppiness in this one. This is a lost trade right there. No trade. Okay, here's a trade. So even with the filter, okay, the filter ends right here, doesn't it?
Mm-hmm.
Okay. Let me see, when is this? This is like February 23. Yeah, it shouldn't be a problem. I'm just looking to see what the conditions are in the market time of year. But this is how it's done. You just gotta. Oh, you know what? I don't think we applied the filter properly. Where's our? Well, yeah, we're not going to do that. All right. Yeah, we did. We applied it right. So let's go here. Background will make green. Yeah, I'm just making this stuff up as I go. Doesn't mean it's going to work, but it seems like it would. Like for this one, your problem is that your volume oscillator is not agreeing, and that might be holding you up on a lot of trades.
But I also, and that's where I'm looking at with the numbers because I have that set pretty high.
Well, might just be you ignore it. A lot of breakouts happen on low volume, believe it or not.
Okay.
So it might be that you just ignore the volume oscillator and just go with the other two. So if I will see, is this green though? Not quite. Yeah, no trade. That's a risky one right there. Yeah, that's a shitty one. No, I don't know, man. Your volume oscillator does seem to call the breakouts. Maybe it is not to be ignored. Maybe just use that. Because this is a good one, and it's within our filter for longs. So if I were to put this over here, I mean, this is a big period of long. So you go in several weeks here, or at least a couple. Yeah. Okay, so let me lock this in. Okay, not quite. This is not, no, it didn't. Let me see if the filter for the volume has to be above what? It has to be above 0?
Correct.
Oh, okay. Then you're I was misreading it. What I need to do is expand this a little bit. I'm not used to using, well, that's not true. Let's do this. So the 0 line is in the middle here. So I'm gonna make this a little more visible for myself here. Style 0 yellow. Okay. So I think you're okay with the volume oscillator. Let's see here. Not quite, no trade. And this is a trade. You might lose this one though. It's not very pretty. So if I were to go along here, and you might not be able to go along because it goes, this Williams dips out. So that's actually not a trade. But this is a trade. This is one of the ones where it goes past 50 and it would be a better trade for you. But, you know, again, I would do this the way you have it. And then the filter is okay to add, like just go long, go short. What you could do, here's what I would do with this, right? First of all, we'll test this trade, and then we'll talk about how I would handle this, because you don't want to change too many things. Just nothing will get done. So in this case, your ATR is right. Oh man, what happened to the ATR?
It's right underneath the candle. That's why I didn't take a couple of those trades.
Yeah. Yeah, you wouldn't. Yeah, that's nasty. The reality though is that you're taking it at the beginning of this candle, and it would have stopped you out. But if you might have a rule, if the ATR is that close to the entry, maybe you just don't, mess with it. That's weird. That seems like a malfunction to me.
Well, that's where I'm dabbling in structure, because if it's way too close, then I won't take it.
Well, let's see where it would have been prior to the candle opening, right? So you're going to, as I hit play on this, TradingView will show you the progression of the candle and the indicators. So where this was at the time of the open may be different to where it was at the time of the close, which when you're back testing the way you were back testing doesn't show that. So if I hit play, see that? So watch this. I'm going to show you something. And this is going to change your entire back test, my friend.
Okay.
You're going to have to start over. I'm going to make this line really like thick and easy to see. Right? And we'll do the same with the above, just, for continuity. All right. So watch this. When this candle opens, the line's way down here. So I'm going to be ready to shoot a line as soon as I hit play. It was right there. You see?
Okay.
Did you notice that?
Yeah.
See how it started here and then it progressed the candle and this progressed with it?
Mm-hmm.
So your real stop loss is actually down here.
Okay.
You see how that works?
Yeah.
So do you know how to use the back tester that I just started using? You want me to show you?
Yeah, if you wouldn't mind.
No, not at all. Okay, so you win this trade, I can guarantee you that. Yep, there's your win, and you could probably get a much better trade out of this. You're going to have to start over, my friend, but this is a good thing because you're going to get more accurate data. So the way that this system works on a single time frame, if you're using multiple time frame analysis, whatever your lowest time frame is where it's going to be set. And what I mean by that is that the back tester goes candle by candle. And it actually shows you the progression of the candle. It doesn't just throw a candle up, but it shows you what the candle did and how it moved, right? So if I had 2 pages open with the daily, then the daily candle's not going to change until 6 of these candles goes. And you get to see how the daily candle behaves. So let's start with just one time frame, right? And let's go back to wherever. See that? That's definitely a news event right there. Because you're on Kraken trading Forex. I wouldn't trade Forex in Kraken, by the way. I don't know if it's good or bad, but I would trade Forex in a Forex broker. Or there's some other options we could talk about. But let's go to like here. What is this here? This is May. Man, nothing went on here. Oh, it's because it's like Friday and Saturday and Friday and Sunday. That makes sense. Let's do like a Monday open. Now, the way to use the back tester, on the top of the screen, there's a rewind button. You see that bar replay?
Mm-hmm.
And you just take it back to where you want to start. And you can go back using your calendar. You can go back to January and do it, you know? So you just got to get on the screen that you want to do, hit that button. And now you have your conditions, right? Now what I'll do is I'll expand these screens to see here you can only do shorts, right? Because we're using our filter. Okay, so I'm gonna go back to like here because what's weird about Kraken, I don't know if it's just Kraken, but these crazy wicks. I don't know. Don't get me wrong, like Forex does that, but these look way more extreme than what I would see on. I mean, this is a European Open. Don't get me wrong, but I'm wondering. I would compare Kraken Forex charts to make sure that you don't get a bunch of crazy wicks and liquidity problems.
Okay.
But let's go ahead. I'm going to move the replay back to the beginning of our short time period where we can take shorts. So, go to select bar on the bottom here. And you look, I'm moving on the left screen, but it's moving on the right for me. See how the left moves way faster? Because it's on the 4 hour. The
Mhm.
right's on the daily. So it's all in sync. So for now, we know we're only taking shorts. Okay. And so in this particular case, we can close this because we know we're in that mode. We don't have to look at that right screen anymore. We only use that for the filter. So now what you're looking for is the stochastic to go below, in this case, below 20, which, that's how you do. You wait for it to actually go oversold. And then you're looking for this Williams to go below negative 80, I believe that is. And you're looking for the volume oscillator to go below. I don't know about volume. The volume, because it's volume, I don't know how this works. Does this account for bearish and bullish, or is it just volume?
I think it accounts for bearish and bullish.
So if it goes down, yeah, I think so. If it goes below the line, that's bearish, and if it goes above the line, that's bullish, right?
Correct.
Okay, because I know you studied these. So all right, good. So in this case, we want this to go below the zero line. So all three have to go below, just like the opposite of what we were doing before. So we're going to look for the conditions. See, I'm going to do one candle at a time. And you're right there, but your stochastic is on the edge right here. So we need this. Oops, let's undo that. We need this just to dip below. We're right there. It's probably gonna happen next candle. We'll see. Not quite. I mean, technically it touched, but by the end of the candle, it came back up. And it's a good thing you didn't take that trade. Okay, so we're in bearish, so we got to let everything come back to your setup. See how it just... The great thing about testing like this is you don't know what's next. It's realistic, right? So now you're in like a weekend, so nothing's going to happen. Okay, so the reason we get so many flat on the weekend is because Kraken actually stays open on Saturdays for Forex. That's weird. Never seen that anywhere. Probably just so that we can get money. So let's go ahead and get through to the market open. So like you're not going to take a trade. First of all, I wouldn't trade on Sundays, even if the market is open, which in this case it's not. The market's not open. So when you're testing on Kraken, if it's after the Friday close, which is like, I don't even trade on Fridays after halfway through the day. I don't touch forex. Like, I trade the market open on Fridays on forex. I don't trade Sundays on forex. So when you're testing, you have to make sure you do not test during times that you would not trade, right?
Okay.
So you're going to have to make sure that you're going to have to do that. So I mean, if you're up early enough, like 1 a.m. your time to trade the European Open, then God bless you. But that, that's not where this is right now. You could trade the Sunday Open, but Sundays, in my experience, are not very reliable. So let's just let the indicators line up. Okay, the Williams is not, there it goes. Williams is not cooperating, but now all three are pretty much lined up. So we can enter here. So let's put in our short bottle. Let's see what time of day. Okay, this is Wednesday, so you're good. So you enter here at this candle. I think it's actually the next candle we have to enter. Yeah. Because we didn't know it was below until the following candle. And then we put our stop at your chosen ATR. We go 2 to 1. Now, we got to remember, right, what we learned is that it's not here at the ATR. It's where the ATR was when the candle started. So you got to shoot a line. You got to hit play and shoot a line. There we go. So it was actually like here. It wasn't where it ended. You saw that, right?
Yeah.
It's very slight on that screen, but you got to be ready to shoot a line. Your stop loss is actually up here. And that now you're going to get realistic numbers. And it might be better, or it might be worse. It might be that you're able to take more trades, or it might be that you get better results. But either way, like, you might take less trades but get better numbers. You might take more trades, whatever, right? But the results are going to be realistic, whether they're better or worse. So let's see what happens with this. You're going to win or lose. You might lose this one because this, I remember the chart getting pretty flat around here. Yeah, there you lose. All right. Now, as you begin to kind of, you're going to develop some things over time that are going to help you capture wins and avoid losses as well, right? And these are ways of like turning these losses into wins, where you say, hey, if it goes past like 1 to 1, then I'm going to take partial profit and move my stop to entry. But that also can make you make less money, because it might be better just to take your hits and get your 2 to 1s rather than scrape out your smaller wins. So the only way you're going to know that, again, is to test. But this is just unfortunate. The market did get pretty flat around this time. I did notice that. It might be like with the Williams percentage, I'm wondering if you would do better. I remember these all lining up pretty well, though. Let's take a quick look back here. I'm going to look at some prior trades just to see. When you read about how to use the Williams, what did it say about this 50% line?
It said that it's bearish or bullish above the 50% line.
Instead of doing like I said on the stochastic, it might be that you do it on the Williams percentage.
Okay.
Because I'm seeing a lot of times where, well, this one, I don't know if this is, let's just quick look at our
My
filter.
entry point was where on the Williams and the stochastic is what I've adjusted.
I don't want to do that. Vertical line. Let's do style back to our blue color here. Just want to see what the filter is here. Okay, that's bullish. And this is the problem you run into not using structure, right?
Mm-hmm.
So you've got a bullish shit right here. You have like a bullish signal, but then you got structure in the way. So now we'll take a little bit of time to talk about structure. So let's see here. Not a bullish signal, but you got a bullish signal right here. And the filter is green. So this is like on the line. Not quite. Interesting. Okay, just going by your current rules, this one I believe is bullish. We'd have to kind of check on it. But then look at what you got here. Let's hide this one to make less noise in the chart. When you have structure in recent history, price is not going to want to go above that. So even though you have a bullish signal, part of your problem here is that you're going right into structure that was created right there. And price doesn't want to go above that, especially, well, just that's how it is. And whenever I'm trading, I always look at structure, right? Let's try to find. See, Kraken is so damn weird. With these weekends, it just drives me insane. I'm gonna go to like a, forex broker. Okay, so I'm gonna go to a fresh screen here, and this will be like we'll just do the filter for now. Okay. Oh yeah, it's got to be. We're not using the filter right. Okay. So the way the filter is, we almost forgot one of the conditions for the filter that we may not have been using. The MACD line, the histogram's got to be green, and these got to be above 0. So if, like, for example, you see how these are red, but it's above 0, we can't do that, right? Now we could take a few trades in here because the blue goes below 0. But then whatever you lost because you lose in here will be made up here because you got these lines are above the 0 line. This on an MACD, by the way, where the green meets the red, that's a 0 line. You can see it on the right. So right here, this is the 0 line. If I were to make that highly visible, why is it not allowing me to manipulate this? Here we go. See the yellow line? That's a 0 line. Okay. So as this goes up, and you're muted, by the way, Larry, just so you know.
Yeah, I was. I'm just listening around.
No problem. So you'll notice that, sure, the red goes below here, and you're going to take some shorts that you may or may not lose in this area, right? Just because you're following the rules. Where the, like this period of the MACD where the blue crosses below, you're just going to get some bad trades. It's just what happens. But here, you can't take any of these shorts here because your blue and your orange, your MACD and your signal are above the 0 line. So this is going to cut a lot of trades out. Like you're going to be not trading for like a week and a half, 2 weeks right here. But here, during the trades you can take, look how bullish that is.
Okay.
So, and this may or may not be the way to go. Or again, this might be the way. Like the filter could work regardless of where it is on the 0 line. For this is the filter could be like, don't trade during this time for longs, right? So the way I would do this is longs only happen like what I just said. These lines are above the 0 and this is positive. These green lines are just where they are. And then your shorts only happen here where the blue line is below the 0. You could even make it a stricter rule where it's like the orange line. You just got to test that, right? So for example, this is shorts haven. You can't take any trades in this time because this is above here. This is green, but it's not above the 0 line. So the shorts are like good to go from, let's just say, where the orange goes below. You could do the blue. I would just do the blue. And then through like the cross. So from there to there, I mean, just looking at the chart, you're probably going to win a bunch of shorts in that time. See that?
Yeah.
So, here where you have the green, it's, green histogram. Just maximize that. Green histogram and above, that's going to be longs. But this period is just a no trade zone. So you'll have like from the 29th of August through the 16th of September, no trades, right? So that's a lot of time not doing trades. Well, you got to develop another algo for that. Or maybe you find a way to use your current algo to where this works. You just change the risk to reward. But watch this. Between these 2 points, where the filter is extremely positive, where you've got, the lines are above 0 and the histogram is green. Let's see. You're probably going to win a lot of longs in here, especially here when it really takes off. And it might be that these ones here are filtered out because your volume doesn't even go above your mark here.
Right? But now,
So,
question with structure there. That, since I'm using a standard ATR, but looking at that, if I go off a structure, I would set my stop loss at the bottom of the last candle at the low.
Well, this is ATR on the daily. You're not using it here.
Okay.
You're using it here.
Okay.
I don't know why that was on there.
But even saying, like, just use a standard ATR with this, or do I need to start using structure for my risk?
For now, for this test, I just use ATR.
Okay.
We're going to talk about structure, and you'll bring the structure in for your next, maybe your next back test, but you are trading a breakout pattern. And when you're breaking out, you are going to trade somewhat against structure. But let's just test the algo as you currently have it for longs. So we have our long period in here. And let's do that. So right as the long period begins, you end up able to trade. Your conditions are all lined up right here. So now that we know your conditions are lined up, let's see where the actual, it's going to be the next candle in from your period. If you want to wait for that, you can wait. If you don't want to take like immediately a trade because the conditions line up before, we'll ignore that. But here's just as you have it right now. This one just barely peaks above. We can't take that trade. The next trade is going to be here as you have it. And that's going to be probably a loss. But you're going to end up with a bunch of trades in here that win. So you're up here. Your next trade is going to be here on this candle. So what we're doing is we're kind of like taking we're taking the pitches down the middle of the plate at this point, right?
Yeah.
Like we're taking the obvious shots. So I would backtest just the way you've already done it with no changes because you were profitable the way you did it, right?
Okay.
But the problem is that you didn't use the replay to know where the ATR actually is. So what we're doing right now is that, right? So right now, well, let's just go, fuck it, right? So we'll shoot the line. So hit play. And it stays pretty consistent on that particular example. So, that's okay. And you'll probably win this trade on a 2-to-1, which is pretty much what's already there. So let's see what happens. Oh, that's a quick win. No, well, not yet, but it's going to win. There you go. You probably would have won that a 3-to-1. And if you're going to use the filter, it might be that you start doing 3-to-1s. You're not going to trade as often. You're going to need to, you need to up your game. Here's another trade right here. And you're already out of this trade. And you see it pops back up on the stochastic. So your next entry is on this current red candle. So we'll go one candle before. Hit play and shoot the line. Okay, it's pretty. I hit the play button. Sorry. Let's go back here. I hit the not the one candle play button, but the
Yeah.
it's just gonna play candle on its own. Just get ready to shoot the line here. Okay, so your stop loss is really down here. Is that where the conditions are met though?
Yeah.
I don't think so. I think it's back here.
We were in that trade though.
This is the trade you were in, and you won this trade.
Correct.
So, all right, so let me hit play. I think it's another candle out. That's the candle. And the stop losses pretty much didn't move. So it's okay. Just, that's where it was when the candle opened. So we'll go along here. And so you have to long at the candle open, right? Now, this candle's a doji, so the open's really close to the close. So we don't have to worry about that. Okay, so we're going to win this trade. You may or may not. You're getting towards the end of the period. We don't know it's towards the end of the period, but we're getting there, so we'll see. Yeah, in real life, we don't know the future, right? So you just follow the trades. Almost stopped out right here. You came real close. The spread might have taken you out on any of these. You're touching that stop loss. The chances are you got stopped out. In reality, we have to be realistic, right? But if you didn't get stopped out, then you won the trade. And according to this, you won the trade. But the problem with these long boxes, even though it didn't stop you out, if I zoom in really close, you'll see that these needles didn't touch the bottom of the box. You see that?
Yeah.
They didn't, but the spread, you're within, you're very, very close. And especially this one here is 98 down to 97. You're one pip away. I mean, you might have won this one. I wouldn't count it, but obviously the methodology works, right?
Okay.
So it's I probably would count that as a loss, to be honest with you. Even though the system says you won, I would count that as a loss. 1 pip away from your stop loss, you're probably out. And you got to draw the line somewhere. You can't just be like, oh, I'm going to take it to 1.7 instead or whatever. You just got to be realistic. So I count that as a loss. And then you're going to have another trade in here. And it's going to happen, but it might be outside of your filter. Nope. No, you didn't get one. Not everything lined up at the same time. And then you're just, out of the filter now. Yeah. So what I would do is, if you're profitable, now you got to go back. You got to do the new stop loss thing. If you're still profitable with that on one screen, do that back test. Do 100 of those, right? Ignore the structure, ignore the high time frame stuff. And the reason is that that's an easy back test that you can knock out. Your forward test is going to take a while. 200 trades is going to take you like a year. You'll never get started on it. You know what I mean? You got to, how many trades on your back test? You did 40 trades and it took you 8 months.
Yeah.
You're never going to get started with that because you're swing trading. So, the purist would say you just got to take the time. You got to go through the back test. You got to wait for the data to come through on 2 years. What I would do with that is I would go ahead and start trading live with small amounts of money. And I would make sure it's money that I could afford to lose, right? And then as you're live testing, I would do a very small amount of money, 10, 20, $30 up until you get up to, maybe 10 or 20 tests. And if you are very profitable in that time, maybe double that, right? Now you're trading because if you're going to trade whatever your account is, let's just say you got $5,000 set aside to trade this, right? So you take that $5,000 and you're going to trade $100 per trade. Well, on a forward test, I would normally, for a day trading forward test where I can get that done in a few months, I'd be trading it at a quarter position size. It's $25. So trade at $25. If you have a $5,000 account at a 2% money management, you're going to be trading, normally $100 per trade. In this case, you would trade 25 to 25%. But after 10 trades, if you're very profitable, if you're winning 8 out of 10 trades, or let's just say your risk to reward ratio makes you very profitable. Let's say your expectancy is $18, which is great. whatever. If you have a high expectancy, then I would go ahead and like double that to like 50.
Okay.
And I would trade that for another 20 back tests. And then, if your account's building and you continue to win at that really great rate and your expectancy is a great percentage of your risk, then maybe up it to like 60 or 75. Like just as you continue to win, up it very slowly. But what's going to happen is as you're live trading, you're going to find out about a couple of things. First of all, live trading is different. Second of all, you're going to learn a few things that you didn't know from backtesting. Just, you're going to learn about news events. You're going to learn about, times to trade, times not to trade. Whenever you're backtesting, for example, like you don't want to take trades that you would normally be asleep during those trades. Like if you have a trade that happens at 2 a.m. your time and you're not up for that, you can't count that in your backtest. But you probably did. So there's going to be trades during your live test that you don't take because you probably just skip some of the rules on backtesting, right? So as you live test, if you continue to be profitable at a very consistent rate, then you up it to whatever your full position size over time. Because you're swing trading, that's going to take you years to do if you wait for 100 tests. 100 live tests is good enough for me, right? Like if I'm trading a quarter position size and I'm profitable after 100 live tests, I'm good to go. But for you, I would probably just break it up into fourths. So do a quarter position size up to 25 back tests. If that is profitable, up it to 50 and you do $50 up to 50 back tests and then up that and up, from $75 up to 75 live tests or whatever it is. And you know what I'm saying, right? Like you just do it that way. But again, I would take note of this filter because I think what's going to happen with the filter is you might have an opportunity to get like 4-to-1s. Like this particular test worked at a 6-to-1. You see what I mean?
Yeah.
And so, also like the way this works is that you do something that's profitable. So for you, single time frame, I don't like to ignore structure, but for now, just do it.
Okay.
And then we'll talk about structure before we end the video. So, but we'll just talk about it so you can know what I'm talking about, right? Like you and I talked before about this yesterday. We talked about how you didn't have any structure on a long, right? So let's go back to this test right here. And let's use it as an example because it's a good example. So on this particular test, if you look on the screen, like for the new people watching, we'll talk real briefly about structure. Price goes up, price goes down, price goes up, price goes down. You're doing longs, right? So with longs, in this case, you're doing longs. I'd say do both, but in this case, we're gonna talk about a long. And let's say your conditions line up right here, and you can enter a trade right there. Maybe it's just a little bit late of a long. Well, price is gonna have a hard time getting past this level of structure. Let me make this a little more visible for the screen. Let me sit back here. So let's do this. When price pivots like this, where price was going up and then started going down, that's a pivot. Price is going to want to turn around right here. It did turn around right there, but as it goes back up, it may have a hard time breaking past that point. And then it's going to head back down and you might lose your trade. Now, if you're in an uptrend and you're a trend trader, that's not a problem for you. You just go ahead and trade it anyway. But that's got to be an established uptrend. And the way to know if you're in an uptrend is by looking at the price action. And we do a whole module on that at Algo Factory. And the other way is to, give me a second here. The other way, sorry, I just had an itchy nose. Drive me nuts. Allergy season is like crazy this year. The other way is to use a high time frame filter, right? So if things are very bullish on the high time frame, then you're good to go. And in a trend trade, you count on this breaking through, right? So in this case, there's no structure back here, right? Well, let's just say you look way, way back into history and you find that the structure is like way, way up here. Okay, so now you know you have some old structure that's important, strong structure, right? So when you don't have structure on which to rely, it's so far away, it's like, okay, price can just continue to go up. Well, how do you choose your targets? I use the Fibonacci extension. So I'm going to use the real extension tool right now. I actually I've manipulated my fib retracement to be an extension tool. But if you're going to use a real extension tool, you take your mouse at the beginning of the impulse up. We'll talk about impulse and retracement in a minute. But this last hard move up, you put your mouse at the bottom of that, and then you move it right equal to the top, and you come back down to the bottom. And you're going to get a 1.272 and a 1618. That's how I have mine set up. You don't have to use those numbers. And then those are your targets on the way up, right? Your first target is going to be better than 1-to-1. I mean, that's just with this stop loss that I just kind of threw on there. It's just, this is an example. We'll use a real example in a minute. That's a 2.3, or even this 1272 is going to be a 1.43. Acceptable. I just need 1-to-1. Right? I prefer 3-to-1, but it is what it is. So that's how you choose your targets, right? So in a real example, like a real, we'll go to the back test here. We'll talk about structure. Now, structure, like the way you find structure is by looking left. And we're gonna hide this noise right here. And so we have a possible trade we're going to take right here. Yeah. Let's get rid of this up here. And you don't see any structure to the left, really. I mean, there's a little bit right here, but we're in an uptrend, so we don't care about this like local structure right now, because this is a trend trade in an uptrend. Now, ideally, you would have caught it down here. My algos will catch them on the pullback in an uptrend, right?
Okay.
Maybe you can work on that later, but we're not talking about that now, right? We're just going to use your deal. So I wouldn't worry about this immediate structure quite as much. And if you look back here, there is not any structure until okay, so this trade we're doing is in 2024 of August. When you go back this far, like the last structure is in December of 23. So 10 months before that. Well, I'll put a line on there. And it's literally the same as the little example that I just created. The relevant structure is so high up here that I don't care, right? So now the next trade, it might matter. Let's put that one up here. So if I go back here, we have that other trade up here that we know is going to happen because we were testing. So if I shoot a line across the top of that old structure, you're going to notice that this trade is going to get cut off by very strong structure. This is a very strong structure. This is unlike the daily, really. If I go a bit to the daily chart, you'll see that structure is it's a pivot on the daily over here. Any kind of pivot you see on a high time frame like this on the right hand side of the screen, so we just do this. That's a strong structure. You don't want to trade against that. Any of these pivots you see on the daily, you don't want to trade against those. And right now there's one, and it's going to challenge that trade that's going to come in the future. So we'll worry about that when the time comes. But for now, there's no important structure that's going to matter for this current trade. So we'll just go ahead and take the current trade. We've already seen, we know what it does, it wins. But here's the 2-to-1. But how would I choose targets on this if I wasn't using ATRs? So the way that the market moves is in impulses and retracements, right? So you have an impulse, and then you have like a retracement, and then an impulse, and then retracement. And then sometimes you have an impulse down, and then you have a retracement up, and an impulse down, right? So the hard moves are impulses. So if I were to let's just do an example here where we're going up, price kind of pulls back, and then goes, you get into a trade on the way up again, right? So that means that probably price had come up and then pulled back down, and you can identify this as an impulse, right? An impulse is the strong move when price, and it doesn't necessarily have to go in exactly a straight line. It can go like this. You can have it could be a consolidation or whatever, or a pullback either way. And then you have this breakout to the upside, and it's going to maybe pull back a little bit, but the whole impulse is this big move despite those pullbacks. So we'll look at some real examples, right? But that's just an explanation of impulses and retracements. And in this case, in our live example here, you have an impulse that's right here prior to the pullback. So this is the impulse from there to there.
Okay.
Then you get this retracement down to probably almost the 786 fib if I were to put a fib on there. So how do we measure fib extensions? We take our fib extension tool. Now I don't line up right at the bottom here. First of all, the bottom's right here. So let's zoom in a little bit, make it easier for everybody to see. See that right there? So I'm going to move from the bottom of that candle that started that to the top. And then I'm going to go all the way back down to the bottom of that candle. And you're going to see these targets right here. There's a 1272 and a 1618. Now the 1618 is the ideal target. And I think we would win if we chose fib targets in this case. That's not always going to be the case. But let's just say, for this other example, well, let's just use this example first. Just hit play. Okay, fine. We got it. We got the win right here. You see it, right? So that's when there's no structure anywhere near. And the 1618 was below this major structure from way back here. Then we're good. The target's below that. Now, the next problem is you got this trade and you have structure right there and it's major structure right here from way back when. What's going to happen with this trade? I've already forgotten. Let's hit play. Oh, this is the one where it probably would have stopped out. The system didn't see it as stopping out, but I would bet if I were like testing this, I would call this a loss. Despite the fact that the system calls it a win, you're just too close to the stop loss. You're less than 1 pip away from the stop. And the spread on the euro is like 1.6 pips. So you lost this trade. I almost guarantee you that, especially on the strong move down. On these strong moves, the spread tends to widen out. So this is a loss because really, you see how it tried to go above structure and this candle got crushed? Let me remove this. These candles tell a story, right? This is a bearish situation after this top candle. This candle, going back to candle theory, what you're seeing here is that the bulls tried to push up. Let me zoom in. The bulls tried to push up and they got crushed all the way back down. Your next candle had the same exact thing where the bulls tried to push up, but they got crushed sooner and the candle closed bearish. Next candle closes bearish, spinning top, doji kind of, or dragonfly doji. Either way, that's indecision. Tall tail, long tail, small body, indecision. Market doesn't know what it wants to do. Then you get a hammer, which can be bullish in certain scenarios, but when the next candle closes so much lower, that's called the hangman. Meaning that this one that looks like a Super Mario hammer that the turtles throw, I know I'm old. Yeah. That one right there, that can be a bullish candle, but in order for that to be bullish, the next candle has to close above it. Now we're talking candle theory, and this is not a candle theory clinic, but the fact that the following candle closed so bearish after this hammer turns it into what's called a hangman. And that means that price is just going to go down after that for a while. And we'll see if it does. I haven't done any candle theory videos because candle theory is like very broad. Oh, well, shit. Oh yeah, we knew that would happen though. So it did go down, but I don't know. This one was not everything works all the time. This one popped up last minute. That's our high time frame filter popping in there. But it did stay down for a minute, but it ended up going back up. But either way, again, the structure from way back here, that structure, that I would have, that's a loss, despite the fact that the system said it won. So we always want to take a look at structure, like at least your main structure on the daily, right? So if, let's just say, let me do this, get out of the replay, delete everything. And I'm going to go to the daily chart. And let's just say I'm trading current time, right? This is the euro. The euro is in a massive uptrend. We know that. So long is the way to go, right? And if you look back on the 4-hour chart on the left that I'm going to open up here, let's just say let's just pretend for a moment that my conditions say go long right there, right? I don't know if I'd take that long, but my conditions say go long. So I'll put a stop loss below the structure right there, and we'll just be real simple about it. Well, what are my targets on this if I already use a fib extension tool? Look at some funny comments on here. Finally looking at the comments on YouTube. It's pretty funny. All right. So in this case, where's my 1272? Okay, so the 1272 and the 618, they're way up here. So now what I want to do is, okay, maybe I can take this. Maybe my stop loss would be a little bit deeper, to be honest, but we're not, I mean, it might stop out, but let's just say I wanted to be safe and put a stop loss below these structures, right? There's stop loss is another class altogether, but let's go ahead and go to our daily, and we're going to take a look at the high time frame structure. And if you go all the way back here, you can see this line, the price is right here, and it just peaked above this bit of structure on the daily, right? So how does this structure built? It's just pivots on the daily, just like it is on any other time frame. Price goes down, comes up, makes some structure, goes down, makes structure, comes up, makes structure, goes down, makes structure, comes up, makes structure, and goes down. Well, price just broke above this pretty strong structure at the top of this bit right here. And the next structure, which is actually, this is pretty strong structure because you have a kind of a double pivot right there. So if my trade was going like to this level, which it won't, I wouldn't take any targets past that level, right? That's how that works. So with the euro being so bullish and structure really nowhere near any of the targets, it's kind of blue skies above as long as things remain bullish. Now, taking this trade, I would prefer to have gotten in on this pullback rather than buying kind of the top. Knowing the euro though, it might be that my what do you call it? Metrics are okay with that, right? So let's just make sure that I'm doing this right. We have our structure noted above. The impulse about which I'm concerned is right here. I'm not sure I would take this trade, to be honest, but I would go ahead and do a fib extension on it. Long position. Now let's get our fib extension tool. Yep. And then we'll start at the bottom of the impulse, go to the top of the impulse, pull back down to the bottom. Yeah, my 1.618 is well below that structure that we marked out on the daily. So I got plenty of room to do that. Now, how would I do a stop loss on this? I would use this pullback structure. And if I got in before the breakout, like one of my algos, I probably would have price come down to here and then come up here. I probably would have entered around here, right? So there's nobody's catching the bottom. You got to be kind of lucky to catch that. You can't really plan to catch the bottom. So I probably would have my structure down like here. For using the ATR, it would actually be all the way down here probably. And then, here you go. Now this ATR, oh, you know what? That's not true. Let's use the replay to get that. Let's do this right. So hit play, get a line to shoot. Not that line, I'm gonna do this line. Okay, let's see. Oh yeah, be even lower. I think it was like down here somewhere. It was pretty low. It's not a very good trade. Well, it's good. It's 1.8 to 1 for a 1618. And that's if I don't take some profit here at the 1272. But just a little bit of the secret sauce for you is if this is bullish and I get a breakout, I'm also taking And this is day trader shit, but it can be swing trader shit, as I'll take this trade and the stop will be tighter. And then I'll take this trade and the stop will be tighter. I'll be taking bites out of this all the way up. But the main trade being 1.8 to 1, I'm satisfied. The structure is way up, way up here. We can't hit play because we're right here, we're at the edge of time, if you will. But this is how it's done. And that's how structure is. You got to look left for structure. So I'm going to do another video that like simplifies the structure conversation and leaves out all the rest of this stuff. But the real simple thing about market structure is you look left and you look past whatever trade you're about to take and you see if that structure is going to be in the way. Just go on a higher time frame, right? You scroll out and you look for pivots. The pivot nearest price is below price. Price is already broken above that. This is not your problem. In fact, this actually becomes support on a high time frame. I'm not that concerned about it, but that becomes a support. Because if you have a resistance like this and price is going towards resistance and it breaks above resistance, that resistance is now a support. It's called an SR swap, support resistance swap. Oaf, Oaf is one of the comments in there. It's good to watch it from the beginning. You will, so we're helping Larry build his algo, but I did want to talk about structure because Larry wasn't using structure. So now that we've kind of talked about structure, Larry, do you understand it? And you're on mute, by the way.
Yeah, I do actually have a better understanding of it. And going back to look at that structure years ago is where my question was. I didn't know if the time frame was too long for that.
No, because that structure, it's on a high time frame. That's more important.
Okay.
It's more relevant. Like now, there's another thing about structure that actually I do need to teach you. Okay. Let's say that in this case. Let's see here. Let's just go on the daily and let's pretend you're trading the daily for a minute. This is the same on any time frame. Well, you have structure on the way up too, don't you? So you have like prices headed up, this whole thing. And then prices just continuing to head up like that. Well, here's the thing. Like, does this structure matter? Does that structure matter? I mean, it kind of does, but it also kind of doesn't because there's inside structure and there's outside structure. Now, this structure that occurred right here and this structure that was this little kind of pivot up here, those both occurred, but price has now covered them. So if pretend you have an eyeball on the far right of the screen and you're looking in this direction, these structure pivots pretend you can't see past price right now, like the current line of price. You couldn't see these, right? Because this structure, this blue line crosses right here. So this really actually blocks that. So let's do it this way. We're going to look at these two older structures, right? Now, we're going to pretend that this is like a barrier where light cannot get through. Right here, this price movement. So price is a barrier through which light cannot get through. Therefore, if you were to draw, if this was light, it would get stopped right here. You see what I'm talking about?
Okay.
If this was light, it would get stopped right here. This is outside structure. This is inside structure. So the structure that light, like that you can actually see, that because light only projects to the right in this case. So light only goes this direction. Light's only going to the right. So the only structure that really matters, these older structures matter. They do. But the structure that matters the most is going to be structure that happened on the right side of price. So in this case, what you're looking at is going to be these kind of structures, right? So now the only reason you'd worry about this structure is if price was going to go down, and price always goes down, doesn't it?
Yes.
So if you're going to go short, the most relevant structure is going to be inside structure. Here, here, and here, right? But if you are trend trading, then you have to watch out, because trend trading is a little different of a story, right? So you're trading with the trend, which is what you're doing. You're breakout trading on the trend. Now, on a trend trade, remember how you trade against structure on a trend trade? And that's not typical, right?
Okay.
But on the trend trade, this local structure, you're going to buy probably, yours gets in a little bit late, but you're going to buy somewhere in here. And this local structure is in the way, right? Because price hasn't gone up yet. Price is only like right here. And you're going to count on it going up, but you're going to have to break this structure. Well, that's what you do with the trend trade. That's okay. That's like when you can do it, when you're in a clear uptrend. But how do you know to buy right here is the question, right? Well, that's because you have this kill zone on the way up. And what that means is that on the way up, price was heading up, came down, and that's why I put this box around here. So you're going to use this structure as where to enter your long if you're going to pay attention to price action. Now, you personally are using algos. You're not paying attention to structure, right? But what you might notice is that on these moves up, if you haven't touched this yet, you might get better results paying attention to this kill zone, letting it bounce out of there, anywhere in that blue, and then looking for your algos to line up afterwards, after it grabs liquidity.
Okay.
It's just another thing to add. But I would, like, the three things I would do is I would do 4 separate tests. Now, the first test is the simple test. And if that's profitable, deploy it. Because in this game, you need to have something running, making you money. So if you have the one time frame, ignoring the high time frame stuff, and it's profitable, and you just got to do the new stop loss. You gotta use the replay function and have proper stops based on the ATRs, right? So that's the only thing you have to change. So I would go back, do that test. And if you're profitable at 20 tests, continue. If you're even halfway profitable at 20 tests, continue. Get to 50, right? And if you get to 50 and you are nicely profitable, then feel free to talk to me about it, but I would just go ahead and back test it to 200. And once you back test it to 200, deploy. Deploy at a quarter position size. $25 a trade if it's going to be $100, risk. If you had a $5,000 account at 2% money management, which means you're risking $100 per trade, then deploy at $25 a trade. Okay. Now, up to 25 trades, then you might want to keep it at 25 up to 50 trades. But that's going to be a long time. Like 50 trades is going to be like several months. So you're just going to have to increase it slowly. You could, if you're profitable at 10 trades, you increase it a little bit. If you're still profitable at 20, you increase it a little bit. Like you gotta not be wasting your time. But at the same time, you don't want to speed it up too fast either, because people get like lucky runs where they win 6-7 in a row and they think they're God. And then they just up their position size all the way, or they even go too high and they haven't tested everything and they're trading way too much money. And then they lose 6 in a row. And then they just stop trading and they've quit and all their time is wasted. So you got to be patient with the process, right? You just got to let it play out. This is not get rich overnight.
No, and I'm also have built-in accelerator in that, and that I didn't do anything with the shorts off those indicators.
That's right. Yeah,
That'll
you'll have more trades in the shorts.
Yeah, that would have been 80, say it matches up even with the longs, that would have been 80 shorts or 40 shorts. It would have been 80 total trades.
And that's just the euro versus the dollar. Then
Correct.
once you've tested that and deployed that, then you can also test and deploy USD JPY. And then you can also test and deploy, there's 8 major forex pairs. So you could, I usually only trade 3, and those 3 kind of change. The euro I trade, which the euro is hard to trade. It's a tricky one. The euro has a lot of liquidity grabs. It can mess with you. But I'll deploy the euro. I'll deploy USD JPY, and then the third is usually switched between like maybe AUD USD, or I like the GBP JPY is a really good one to trade. It's very volatile. It's called the beast for a reason. Don't get weird on me, religious people. It has nothing to do with the devil. It's just called the beast. So as far as I know, whatever, right? Go make your money. So I would test and deploy on all 3 of those, just the original algo if it's profitable. And that way you're going to, yes, the testing time will take just as long to ramp up, right? Because you're still going through those same amount of tests per pair, but then you'll be deployed 3 times. And as you're testing, once your back tests are done, you're already back testing the next version of your algos. You might be live testing and still in the beginning stages of the live test with the smaller money, but now you can back test your new versions. And the new version I would do first would be the filter.
Mm-hmm.
I would do it. I would do it like, let's do it like this. I'm going to take some notes in the in your Telegram.
Perfect.
So I do it, iteration 1. The no-go filters, which is just going to be actually like longs. That's almost built in. Like no-go filter is no longs when shorts. Let's talk about this. Let's actually assess this. The way I would do a filter would be really simple. If you're just going to like go straight up on one screen, but then add a filter, I wouldn't worry about above or below 0 with this, just for a time. Maybe for like 50 tests. When it's red, no shorts. When it's red, no longs. When it's green, no shorts. Simple as that. Don't worry about above or below 0. If you're profitable already, then this might cut out some less profitable trades. Maybe.
Okay.
Right? Because you can take shorts and longs, but it's going to be half the time, right? Like it might be, if the histogram is green, no shorts. If the histogram is red, either shade, no longs. Just do it that way. So I'm going to type this. So no-go filter is based.
That'll allow me to have safe areas to look back at structure previous to see if I could up my risk to reward. Those 3-to-1s and 4-to-1s you were talking about.
Yeah, I wouldn't go there just yet. Keep it simple. Maybe you're not, maybe your 4th iteration on that. Yeah. Or what you can do with that, I mean, really is, the easy way to do that would be on your first iteration, right? You could just simply, hold on a second. One of my buddies.
Well, the fact that I'm at this point in 2 weeks of being in your classes and your modules just is a sediment to what you're actually providing.
Say again.
I said the fact that I'm at this point after only consuming your content for 2 weeks just shows to the effectiveness of what you're putting out there.
Oh, I appreciate that. I'm glad I didn't hear it, so everybody can hear it twice. But yeah, it's, and to be fair, you do have some experience with charts. So I know there's people coming in fresh that may not get it quite as quick as you do. You went through another system, and obviously it was not exactly trading. It was more investment. But either way, to look at this, I would say as simple as that. Your first filter is based on histogram color, right? And then your next thing, your other iterations, I'll call it iteration 1.1. That can be like adjusting stops and take profits to maximize. Now, yeah, if you want to use structure for that, you can, right? It's an option for you. If you want to just change your ATRs, you can do that too. But the simple rule can be just like simple rule: don't trade against high time frame structure, right? Iteration 2 can be the supercharger. And this is where I'd really look to increase risk to rewards. And that's using the filter with histogram color plus above below 0. And that's MACD on the daily. Okay, so okay. Okay, so histogram color daily MACD. So give me 1 second. Okay, so what other iterations do we talk about? We have the filter, we have the supercharger, and we've got the I mean, you could enact the structure one immediately. You just go back and look at the old structure and shoot your lines. That doesn't have to be like,
Yeah.
I'll call that iteration 0.1.
Do we have in there the readjusting the ATR line?
Yeah. No-go filter. So let's do it this way. Control X. So I'd say new things to introduce immediately. A, no trading against major structure. B, adjust stop loss line. Okay, so and then so those will be things you put in right away, right? I think that'll make a big difference for you. Those are general rules that I've tested. Not the stop loss line just makes obvious. That's not something I've gone back and done a million times. But the trading against major structure, that one is like trading 101. You don't want to go against major structure. Price almost always will not do what you want it to do. But then when it breaks, if and when it breaks that structure, then you can actually do really well. In fact, with major structure, it's a lot of people just short that. They don't even, that's their only rule. It's like, oh, it's up at it's at a resistance, go short. Like that's just what they do. There's no fanciness about it. A lot of people, and those are successful traders. So you got no trading against structure, adjust stop loss line. Those are things you do immediately. Iteration 1, no go filter based on histogram color only. And then iteration 2, supercharger. So I think what you could do is run iteration 2 parallel. Once you have tested iteration 2 and you've optimized it, you've tested some different, what's going on with my screen? I need to fix my deal here. How long it's been like that, I don't know. Once you've done that and you've tested it, it's good, you can run it in parallel. You can, because what's going to happen is the opportunities on the supercharger are few and far between. You'll go like 2 weeks with no trades, but then during those weeks where the trades are really good, then you can have a separate system with separate, it'll be separate, like recording of results. But you can run both of those systems at the same time. And you can, you could record the data. What I'm saying is that the entry logic for both of those systems is the same. The exit logic is different. And that's on the 4-hour time frame. The difference is the supercharger adds in the daily supercharge. So the take profit on that is going to be like, obviously you're going to have to figure out what the optimum is, and it's going to be different for the euro than it is for the USD JPY. Like you're just going to have to test and optimize, right? You're just going to have to see how that is, like what works best. And this is when eventually, when people get to the point where they're coding things, they can do an automatic backtest. But the problem with automatic backtesting multiple time frame analysis is that the look aheads actually create overly optimistic results on TradingView. But it can be done on other platforms. That's like way ahead of what we need to talk about right now. So what you do is you create these, you deploy them, you trade them manually, and then you develop the money that you can pay a coder that you trust to just deal with it and code it for you. Unless you want to take the years it takes or whatever to learn the coding, and that's not something I would do. But either way, you know, that's what I would do. I think we have our, you know, marching orders, if you will. And I put it in your Telegram. So before we hop off, are there any other questions that you might have?
No, I appreciate it greatly.
Yeah, well, I do too. And I had kind of a window scenario there for a minute. I didn't hit the right button there for a while, so hopefully it didn't screw up the whole thing. Hippocratic Oath asks, what language am I using for the coding? PineScript, because I will code on TradingView. So if you guys want to see my algo that I've had coded, here's gold, and it called for a short, and this is on the daily. It called for the short on Thursday the 26th at about 33.36, and now it's down to 32.74. If I were to like look at just Bitcoin, and this is on the daily. I mean, it works great on other timeframes too. This is go down to like the 30-minute time frame, and we'll go on just look at the euro. So you see some like the little tabs. That's my algo. You know, this is a win. That's a big win. This is a nice win. So I've had those coded. It's not my best algo, but it's the best one that I've had coded, right? So PineScript, to answer your question though, because this is all TradingView based. So that said, you know, once you get to that point, you've gotten to that point, right? And I have somebody who was willing, you know, like when you pay a coder, they're tricky. It's kind of like lawyers. If you ever seen like a not good lawyer, what they'll do is they will like charge you, and then they say they need more money to finish, and they always need more money to finish. Coders could do that to you as well. So you agree to something, and the coder's like, I need more money. It's taking longer than I thought. Or like, you know, you pay them, but then it's just they don't want to do it anymore, and they just disappear. Like finding a coder that you can trust is really key. I have one, although he's kind of retired and he only works with me. And that's just because of the relationship with the alt media company that I help run. But I know some coders out there that I could probably trust. We got guys at Algo Factory who code. They'll probably take your money. It's not cheap though. You know, it's just a few $1,000s. Larry, I think you got a hard stop coming up here, don't you?
Yeah, if you don't mind, I got a working thing I got to get to.
That's okay. I think this is like 2 hours long or something. So
yeah,
we'll cut it short here. But let's see here. Hippocratic says PineScript. Never heard of it. Yeah, it's TradingView's native script. So you go to tradingview.com. It's their native script. It's similar to, I think, Python. It's lightweight, it's trading dedicated, and the libraries are immense. So Larry, thanks for coming on and doing this. I hope it's helpful. Keep me updated on your progress, and you know, we'll do the next thing. All right.
I appreciate it. Thank you very much.
Anytime.
All right. We'll see you guys.
See you. All right. Well, before I go here, does anybody else in the chat have any other questions as well? I'll leave it for a moment. Okay. There we go. Oh, looks like people are watching. That's great on autopilot. Hope this helped. Sorry for the window look. That's just I hit the wrong button at some point. But yeah, it's live. Everything's live. One of my Vahali was asking me in the background, I know him, and he's like, "Hey, is this live? It looks like a window." So it is what it is. But thanks for watching, and we'll catch you on the flip side.